RateScope here. If you stack silver or even just watch the price every day, you've probably heard people say, COMEX is rigged. It's all paper. The price is fake. There's a lot of emotion in those statements, but very few people can actually explain what COMEX really is and how it works. And if you don't understand the plumbing, it's very easy to get lost in fear, hopium, or pure noise. So in this video, we're going to slow down and walk through what COMEX actually is, how paper futures on COMEX end up driving the price of physical silver, the difference between registered and eligible silver in the vault system, how COMEX is essentially a fractional reserve silver bank, and what all of that means for stackers, ETF holders, and traders. No hype, no trust me bro, just the mechanics. Let's start simple. COMEX is the commodity exchange division of CME Group. CME is a giant umbrella company that owns the Chicago Mercantile Exchange, GE, CBOT, Chicago Board of Trade, NYMEX, and COMEX. So when you hear CME raised margins, COMEX open interest, or NYMEX crude, it's all under the same corporate roof. COMEX's job is to provide a centralized marketplace for futures contracts on metals like silver and gold. A futures contract is just an agreement. I will buy or sell a certain quantity of silver at a certain price on a certain future date. For silver, one standard COMEX contract is 5,000 ounces. If the futures price is $25, that contract represents $125,000 worth of silver in theory. Now, does anyone actually wire $125,000 just to open one contract? Almost never. Instead, they post margin, a sort of performance bond. CME might require, say, $12,000 of initial margin per contract. That's around 10-to-1 leverage, $12,000 controlling $125,000 notional. This is where COMEX becomes powerful and dangerous at the same time. It lets miners, refiners, industrial users, and speculators in New York, London, Shanghai, and everywhere else transfer risk and use leverage. But it also means price can move a long way very quickly if margin changes, or if big players all rush to one side of the boat. Who uses these contracts? Three main groups: hedgers, producers. A silver miner knows roughly how much metal they will produce over the next year. They can sell futures today to lock in a price and avoid a collapse in revenue if spot falls. They are willing to sacrifice some upside to protect themselves from downside. Consumers, users, mints, refineries, electronics manufacturers, solar panel producers. They buy futures to secure a cost for their raw material, so they don't get blown up if spot suddenly doubles before a big production run. Speculators, traders, hedge funds, CTAs, prop desks, high-frequency trading firms. They don't produce or consume silver at all. They just want price exposure and leverage. All of them meet on COMEX and transfer price risk from one to another. In theory, this is healthy. The people who need certainty get it, and the people who are willing to take risk get paid. But here's the twist. Even though most of the action on COMEX is just paper trading paper, the prices discovered there are treated as the spot reference for the entire world. When your dealer updates their price board, when SLV calculates its NAV, when a miner marks its hedging book, they are all looking at COMEX futures prices and London OTC prices, which are closely linked. That's how paper COMEX turns into real-world pricing power. Before we get into the vaults, let me make the restaurant analogy because this is the easiest way to visualize it. Imagine a busy restaurant. 95% of the people inside are just swapping pictures of food and betting on whether the price of steak will go up or down tomorrow. Only 5% of the people actually sit down and get served a real meal. The restaurant is still packed. There's a lot of activity, but very few plates are actually leaving the kitchen. That's COMEX. Tons of volume. Very little actual physical silver changing hands. Most futures are opened, traded back and forth, then closed or rolled, with final settlement in cash, not metal. Only a small percentage of contracts result in, I'm not closing this, I want delivery, give me the bars. And that's where vault inventory and the registered versus eligible story come in. COMEX doesn't keep all its silver in one giant James Bond-style vault. It authorizes multiple vault operators. JP Morgan, HSBC, Brinks, Loomis, a few others. Each of these reports daily how many ounces they hold under the COMEX umbrella. But we have two key categories: registered silver, eligible silver. This isn't just a terminology game, it's how COMEX hides and reveals its true deliverable capacity. Registered silver has been explicitly designated as available to deliver against futures. If a long stands for delivery, registered bars can be transferred from the vault to that long. This is what we might call the active inventory of COMEX. Eligible silver meets COMEX specifications and sits in an approved vault, but belongs to someone else, an ETF, a bank's proprietary holdings, or a private customer. It is not automatically pledged to satisfy delivery demands. Eligible bars could be reclassified as registered if the owner decides to make them available, but there is no guarantee they will. Think of it like this. You own a big parking garage with 12 limited spaces. One spot has your own car, an old but reliable Honda Civic. 11 spots have your neighbor's Ferraris. How many cars are in your garage? 12. How many cars can you actually sell tomorrow to pay a bill? 1. If someone asks, how many cars are at your facility, and you answer 12, you're technically right. But if they're asking, how much liquid inventory do you control, and you still answer 12, you're misleading them. COMEX often talks about total inventory, registered plus eligible, because it makes the system look well stocked. But for delivery stress, registered is your Civic. Eligible are the Ferraris you don't own. Recently, that Civic pile has been around 103 million ounces. Total inventory, including Ferraris, might be over 400 million ounces. But those extra 300 million plus are not automatically available to fulfill futures delivery requests. So here's the question. Why would COMEX allow so many more paper claims than physical ounces? Because COMEX is structured, by design, as a fractional reserve silver bank. The idea is, only a small percentage of people holding futures will ever ask for metal. Most will just close their contracts for cash. So the system can clear a very large notional amount of silver exposure with a relatively small pool of registered metal. It's like your bank. It issues many more deposits than it has cash in the vault. It counts on the fact that not everyone will show up for withdrawal at the same time. This structure has consequences. Under calm conditions, there's no visible problem. Under stress, when more people want bars, not dollars, the leverage starts to matter. Let's walk through a simple futures plus delivery example so you can see how it actually plays out. Suppose you are long 10 March silver contracts. Each contract is 5,000 ounces. You control 50,000 ounces on paper. Price is $25. Notional exposure equals $1.25 million. You've posted, say, $120,000 of margin. Now imagine you hold those contracts into the delivery period and you say, I want metal. I'm standing for delivery. If you have enough funds in your account to pay the full value, you'll be assigned warehouse receipts representing those 50,000 ounces. On the books, short side of those contracts delivers. You receive ownership of specific bars from the registered pool. Registered inventory falls by 50,000 ounces. In reality, you might leave the bars in the COMEX vault system under your name, transfer them to another depository, or eventually ship them out into the wider physical market. If a small minority of longs behave like this, COMEX can handle it. If that minority grows, registered inventory shrinks. If it shrinks too far, the exchange has a problem. That is why registered versus eligible. Daily withdrawals, delivery percentages are not trivia. They're stress indicators. So how does all of this get back to paper versus physical for you as a retail investor? Under normal market conditions, paper futures on COMEX, OTC forwards in London, and spot prices tracked by ETFs all line up. Dealers quote spot plus premium, where spot is basically COMEX LBMA. If there's a small discrepancy, arbitrage traders step in to profit and close the gap. Under abnormal conditions, COMEX price can be hammered lower by big paper selling, margin hikes, or algorithmic trends. At the same time, physical markets may see strong buying, limited supply, long lead times. This is when you start to see high premiums in local coin shops and wholesale markets, backwardation or unusual futures curves, divergences between COMEX and regional hubs like Shanghai, Dubai, or Zurich. At that point, the spot price on your favorite finance site is telling you more about how stressed the paper leverage is and less about what it actually costs a large industrial user to buy 10 million ounces of physical tomorrow. So what does a rational person do with all this? If you're a stacker, understanding COMEX mechanics helps you see through daily price swings. You stop reacting emotionally every time silver is slammed $2 by futures liquidations. You start asking, what are inventories doing? What are lease rates doing? Are premiums and delays getting better or worse? If you use paper products like SLV or unallocated pool accounts, you recognize you own a claim inside a system that can change settlement rules, margin requirements, and delivery mechanics. You might still use those tools, but you understand they are not the same as coins and bars in your possession. If you're a trader, you treat COMEX like what it is, a highly leveraged, rule-driven environment where house rules can change, moves can be violent, and you are not in control of the plumbing. The goal here isn't to make you paranoid. It's to move you from emotion and narrative to mechanics and numbers. COMEX is a price engine, a clearinghouse for leveraged risk, and a fractional reserve silver bank, all rolled into one. As long as you remember, registered is not total. Paper is not want guaranteed metal. Leverage is not want free money. You're already ahead of almost everyone screaming about silver online. If this breakdown made COMEX and the paper versus physical structure a bit clearer, hit like, subscribe to RateScope, and drop your thoughts below. Do you treat COMEX prices as a useful reference, or are you already ignoring the screen and focusing only on physical fundamentals? This is for education, not financial advice. Always do your own research and know your own risk tolerance. Invest with logic, not hype. RateScope out.